Hi everyone, this is Terry with Futures.io, and it is my pleasure to welcome back Mario Ranholm for today's webinar, Trading Computer Generated Info. Now please feel free to type your questions into the questions box throughout the event, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And without further delay, I will hand it over to Mario, and you should get the pop-up to share your screen now.
Let me see. Yes, show my screen. Great. So let's go full screen.
Okay, looking good.
Okay, great. So thank you so much for hosting the webinar, Terry. Let's start. The first thing I want to talk about is the disclaimer. As you all know, futures and options has large potential of risk and reward and so on. So please, all the information here is for the educational purposes. And I want to thank the Futures.io community, because the blog have saved me a lot of hours of research and money. So today, like Terry said, we're going to analyze or how to trade computer generated information. And what is computer generated information, and how do I use computer generated informations? So, but before we start, let me give you a little of my background. I've been a professional trader more than 11 years. I worked for banks in Europe, and at the moment I'm managing capital for corporations in the US, Europe, and Latin America. And I'm working with RandBots. I am the manager of RandBots, which is a capital diversification platform. My background is an MBA in a business school in Madrid, IE Business School, and I did my bachelor's in New York in Adelphi University. So for me, computer generated information changed the way I trade. And I want to show you a glimpse of that today. So first, it saved me a lot of cost, right? It lowered my cost. It gave me a lot of higher quality results on risk management, especially, and increased my efficiency, especially because as soon as I started using computer information, emotions got out of the way and my trades improved greatly. It is very important when you start trading that you find your personality as a trader and you trade a system that matches your personality. For me, it meant about 10 years ago, I started trading options heavily, and that changed the way I traded, and I became a lot more confident trading those products, as well as it helps me to gain a better risk-reward ratio based on my personality. So here I have a little chart that explain my personal time drainage. This is 1999 to 2005 when I started trading, and I was doing 100% manual trading. As you can see here, almost 40% of my time was dedicated to opening, right? To opening risk. This is probably entries and so on. Then managing the trade was a little less, and a lot of time went to close the trade. Of course, I was doing some of the review and very little time in improving, right? Improving my systems or my entries and my exits. It was very little time. As I progressed, I included manual, like I went 50% manual, and then I went to 75% automatic. And in the last years, since 2012 to the present, I'm very much doing all my decision matrix automatic. And this have changed the way I use my time. This is especially after the MBA because I learned about computer-generated information and how to take advantage on this. So as you can see now, I devote very little time to entries, managing, and exits. I'll devote some significant time to reviewing the risk, right? And a lot of time to improving the systems. So this was the result of automating a lot of information, and I will show you during the presentation how I automated information, because it's not, you don't have to really rely on coding or programming. There are simple steps you can take or that I took years ago that changed my trading significantly. So if we go to the following chart, on the right side we have the performance of a medallion. This comes from Bloomberg. There is an article on Bloomberg, quite interesting. This is probably one of the most successful hedge funds in the world, and I want to show you the type of returns that this hedge fund obtained, right? So this line here was about 14 years ago when I started trading, and it had the worst year was 2016 for the fund, with about a less than 25% return year to date. The best year was about 100%. We have to take into consideration that this fund manages about $20 billion. So generating those returns with that capital is something that it's amazing. But I want to show you this chart because most of the trades they do, or probably 100% of the trades they do, it's with computer generated information, right? They get the analysis, they get the data, and then they do certain analysis with computers to get entries and exits. So we're going to review some of the things I have developed during the last few years that I think they can help you. But it is very important that if you have access to data from these type of strategies, right, that professional trades, what would you do? Think about this. There are ways to get professional trading signals that manage capital for institutions and clients around the world. But would you trade those signals considering your risk appetite, or would you just connect the system? Would you select a system based on your personality? What about with the tools at your disposals? Will you trade a system that is a trend following system and follow the trades knowing which moving averages is the computer analyzing to enter and exit positions? Would your personality allow to be auto trading a system like this? Would you 100% trade automatically, or would you mimic some trades? So this is something important because in the beginning, when I started trading, I tested many strategies for various corporations. And it was very complex for me to trade strategies that did not match my personality. I ended up not following 100% the strategy, and that is the worst strategy you can do. It's not follow 100% a strategy. Okay, so let me give you some of my answers today. But before of this, let me explain what I mean with computer-generated information. For me, a computer-generated information is simply the result of a computation. And I will show you this. You have unemployment number, and I will show you the delta of these unemployment numbers. So the unemployment number you get from trading platform, from brokerages, from the regulators, and so on. But it's delta, the analysis, you don't get from those. And this is what I call computer-generated information. Then I divide this into two types of data. One is alpha, right? Alpha computer-generated information, and the other one is risks. The alpha translates into a simplification of a trade alert. Okay, so we are here in the chart. We get computer generating information, and we have, if it goes to alpha, it goes to trades alerts, or if it goes to risk data. And the risk data is a market event that alter a combination of signals. For example, very easy to understand, if we are trading and the computer reads a high on the VIX, a high on gold, a high on the S&P 500, and a high on the US dollars. This is not very typical, but it had happened. It could be in the same print or within 10 minutes or within 1 minute, depending on your time frame, this thing could happen. So if we have a high on these 4 products, I'd receive an alert saying there is a high on the VIX X seconds ago, a high on gold X seconds ago, it was a high on the S&P 500 X minutes ago, and the US dollar had been trending higher for the last 2 or 3 days. So this is information that I would not be able to process if I did not have the computer help, right? And then what we do, if the risk data, so let's say we get the alpha, the signal, right? We combine this with the current positions, and we consider if this add risk to the system, right? If it doesn't add risk, we put it here, and we trade, it goes to the trade list, and then it goes to an execution, right? So let's say we get a signal. It could be our proprietary signal or third-party signal that we are purchasing. So let's say we get a signal saying long S&P 500. If we wanted to go long S&P 500 before, but we did not find a proper moment, that would be a system or a signal that did not add risk because we were looking for a place to add. So it will go to the trade list and it will be executed. If the same data, if we get the same signal when we do not want risk on the S&P 500 because we are already at max risk for the hour or max risk for the day or max risk for the week, it goes to a risk analyzer. Because if I add risk, it goes here to risk data because there is a third-party system or a new system that we trade wanted to add risk at the current level. So it goes to the portfolio construction, and if we do have in the portfolio expectancy ratio room to trade the S&P 500, it will trade into an execution. So to sum up, alpha computer-generated information is to generate income, right? The goal is to generate income. And risk computer-generated information is to modify market exposure, right? So let me give you an example on the unemployment number data. So this is probably the way most traders see the unemployment level, right? So this is the unemployment level in the US. The orange line is the payrolls from the 70s to last quarter. Then there is the blue line is a survey, which really is close to the orange line. And the green line is a household survey, not adjusted, right? So if we analyze this data to take trading decisions, first, it's very hard for me to obtain conclusions based on this data, right? Second, when I analyze this data with different graphs or with different charts that we're going to see, it creates a model that I comprehend. So it gives me an insight of what to think and how to process this data, right? Also, when the decision is taken, I can cross-check past data with the outcome that I'm looking for. For example, going long the ES when the stocks push higher or not. And I will show you this in Excel. in a few minutes, right? So now let's show you similar data, but with a different chart, right? So this is the European unemployment rate. You can see this is the change. Instead of the entire number, like a million of people employed, like we saw here, right? We see here the change into millions. And this gives you more information and it's easier to react, right? However, I found that once we process the information, it gives me a lot more information, and it's easier for me to find quality data in the same data set. So for example, here in this bubble, we have the US unemployment payrolls since 2008, and this is the monthly change payrolls. These three dots were from 2008. About 80% of these dots here are from 2009. About 80% of these dots here were from 2011 and 2014. Of course, with the slope of this curve, we can take investment decisions. We could execute trades buying or selling the Nasdaq or the S&P 500 or the Dow Jones with a greater information just looking at this data here or this data here. The computers can relate that if this time of this performance was related to 2009 data sets or related to 2011 data sets. Or for example, here we have the unemployment rates for Spain divided by states. So we can see here Madrid, where it enjoyed a 14% return. We could do this as well for the US on states levels, but I wanted to show a different country. Or for example, in Valencia, where there is a 90% unemployment rate. Of course, this data set gives you information, but when you change it to different ways of graphing and analyzing the data, you get a lot more information that could be beneficial into the trading. If we cross-check this data, right, we can analyze even a more detail, an entry or an exit, right? Here we have the World Economic Policy Uncertainty Index. And every time, this is a simple Bollinger Band on the index, and every time that we traded higher than the top of the band, we quickly reverse, of course, in a quarterly basis, right? We reverse, but allow the S&P 500 and the VIX to trade into a new quarterly high. So, for example, the last time that the uncertainty index traded above the Bollinger Band was in the US elections. The time before was in Brexit. The time before was in the European refugee crisis. If we connect this with this data here, if we cross-check the data here, we could have a better signal or a better entry and could give us a lot more information if the market could be just suffering a retracement, or this could be near top or near bottom, depending on what data set we are looking. Right? So great. This is some of the examples how I use market market and computer generated information, but how can you create it yourself? How can presentation help you? So let me give you some of the tools that I think you might have at your disposal. First, you need to understand your personality and look for a strategy that matches your personality. For example, in the beginning of my trading career, I was trading equities. And then I gravitated to options because it matched my personality. I was not doing very well having a 50 or 60% win-loss ratio. So I went to strategies that gave me a higher expectancy of winners versus losers. So I went and I gravitated into options. That worked very well for me. If you want to improve your day trading abilities, I would start making one day trading system that have positive expectancy ratio. If you have questions about systems, I could help you after the webinar. If you like to follow fundamentals and pay attention to the news, I would trade, right, as a system that focuses on sectors and not into day trading, maybe a swing trading systems. So some of the tools I think you have at your disposal that could be beneficial are moving averages. This is how I began to filter trades, and I still do, because moving averages are able to remove significant pain on the losing trades, right? Bollinger Bands help you in entries and exits. And flow analysis tools can help you with timing as well. Yes, and most of us are used to moving averages, Bollinger Bands, and flow analysis tools, but I don't use them on charts. I am a very visual person and I like charts. However, my trading decisions are done in Excel. And this is what changed my trading. And then I started following and filtering third-party systems. And if my Excel said the opposite of what the third-party system does, which I trust, I'm able to trade against those systems to minimize the risk or to find alpha, because I think that trade, a specific trade on the system, might have a negative expectancy ratio. So it's easier. We're going to analyze three examples that you could use the data. First is a long-only system, right? Long-only systems are good because they have a lot of cash. And for me, it was a self-development stage because this is how I started. So it helped to only look at one side of the market and then looked for another systems. Then we're going to analyze a big system, right, on risk management. And the last example is going to be a real-time option data and how it leave footprints, right? So most of your brokers or data providers could provide an API and or Excel templates which you can adopt quickly, right? And let me show you one of the ones I use because it could be beneficial for you. This is, let me make this bigger. This is a template for the indexes. Let me make it a little bigger. So this is real-time data coming from the exchanges, right? The ES, the YM, and NASDAQ, the last price, the tick, that means it was a neutral tick. It was not in the bid or the ask, right? The plus sign means it was an aggressive buy, and the minus was an aggressive sell. the change, the volumes, and so on. And then I analyze the spread a lot, right? So this is real-time data coming from the data provider. The same thing you can do, oh, I don't have it here, with interactive, but let me show you an example how I would use, or how I started using moving averages that could be beneficial to you. So I create a chart. Let me go for Apple, for example, right? Line Apple, right? So here we have the Apple chart. This is the price. We could do this week, right? And these are the moving averages. Let me actually show you how to add the moving averages, right? So here we have the moving averages, and then we get the data. So the way I get the data is this, right? And then here we have a simple moving average, right? This is about 15 periods, this is 20 periods, and this is 30 periods. Something I started, it was with an if function, very easy. If the fast moving average is higher than the low moving average, then give me, oops, where is it? Give me a buy. If not, give me a 0. Okay, so we take this to the low of the series, that it goes to today's date, right? And the same thing I do with a slower moving average and the first one, right? And I take this to the low, and the same thing I do with this. However, if I go like this, give me a sell signal. This is an example, okay? Sell, right? Let me double check. Okay, so here we have a very simple system of filter that would give me buy signals. This is when the fastest moving average trades higher than the middle moving average, and this would give me the opposite signal, a mean reversion signal, when the slowest moving average it's higher than the middle moving average. So let's pick one of the dates from the last few days, right? So what I do, or one of the systems that I use is I would get a buy signal here on Apple on the fast moving average, right? But I would not enter until I find confirmation from the second moving average, right? So this for me would be a buy zone of Apple, right? And this here would be a sell signal, or a reduced risk, or limit, the limit of trailing stop. Let me change it to, instead of selling, I would say trail stop, right? So here, So for example, I would have gone long, or this system would have purchased on the 12th, right, December 12th, until the 3rd. So let me see. So the 12th. I can show you the interval. One second. Let me create another chart. Okay. Candlesticks, and then we can zoom in. So the system went long from the 26th, right, to the 3rd, and then I would change to a trail stop. Let's see how we would have worked. So buying the 26, buying here, right, after a gap down, and then getting a trail stop on the 3rd, right? So all of this time would be buying pressure from this system, and then I would have moved a trail stop here simply because of the moving averages. Let me add here the moving averages. Moving averages, so moving average, triple moving average, 14, 21, and 35, add, right? And this is what would have happened with the signal. So this is something that it helped me very much because I was filtering hundreds and hundreds of stocks with very basic systems and day trading this strategy with the confidence that 3 different signals match at this time. So this is something what I would explain as computer generated information. And this, if you have questions, we could always, of course, answer them on the back, on the last part of the presentation. The other one is a similar trade. This is a system that trades SLV. This was silver, that the system went long on silver. So I saw that the system traded the account and purchased silver long. And I was looking to trade to add exposure to commodities. So after this, I saw, or I went to look why I wanted to add exposure into commodities. And I noticed on December last year that it was a lot of auction trades in the calls, in the 15 and 20 calls on silver, right? So I leveraged this system, this long trade, that was a third-party system, to enter into commodities because I wanted to add exposure into commodities. So I was filtering a filter. So this was with the help of Excel and not analyzing charts. Of course, it's a lot easier to analyze hundreds of data when you look at Excels versus charts. The second example is an attachment to a loser, right? This is a system that I analyzed and I did the due diligence of the trader and the system. And I have mimicked over 120 trades from this system. However, one day in the morning in Asia, I noticed that the system had an average of 3 times the risk on natural gas, right? And natural gas was not as an instrument that was the great performer for this system. Let's say natural gas was not the moneymaker of this system. So I considered the trader not being an expert on natural gas, and I found the system to have 3 times the average size position. So I was looking for ways to improve that market exposure and that risk. And of course, you need to follow the plan. You have to have a plan in advance for this. My options were to lower the size, which I did not, lower the bet of this system, adding the opposite positions, which I did not, right? And then it was to trade options, because of course I knew that the volatility on natural gas have changed, because this system measures volatility, and the only way it goes against the trade is because a volatility shift. So my option was simply to talk to the trader and to lower the risk. But I had a plan to follow when these systems happen, when this drop happened on the system. There is a link here on the video if you wanna read more about the systems. And the third example is a leveraging data that I am already analyzing for other systems. So let me give you an example. Probably most of the clients, or the most popular system is R option, right? R option is a market timer on SPY and QQQ. R option measures volume delta on many stocks, right? And the system used to look at yearly, quarterly, weekly, and daily data. However, I found that with the help of computers, I was able to look at 1 second data, 1 second 33, 1 second and a half, about 2 seconds, 2 seconds and 1/3, and so on, of many companies at the moment, to find if there is buying pressure or there is selling pressure in the whole index. And I was not able to do this before I got into Excel, and before I was able to look at multiple or thousands of stocks, because charts are not very good for analyzing a large quantity of data. So I developed an intraday long system that uses similar data that are option, but in a very short time frame. And I will show you this in Excel afterwards. And here we go into the part analyze and improve. This is a trade that was executed in January 22nd. So yesterday. It was a long on the indexes that was executed yesterday. I am explaining alone because it's easier for all of us, and I'm explaining a winning trade because it's easier to explain a winning trade, but we could do it with a losing trade. I think it's beneficial to show it how the process would have worked, or how the process worked. So most of us do a very good job learning setups and acting on patterns. Most of us are able to see a top similar to this one, right, on the S&P 500, or congestion similar to this one on Nasdaq yesterday, or a high and then a retracement on YM to later approach the higher high on the Dow Jones, right? So the signal occurred yesterday at the candle, right? The candle points, sorry, the arrow, the green arrow points the exact same time on all of the indexes. But my question trading this was, should I go long the ES here at the high, right? Should I go long the NQ here after already went through the high and the conjunction, right? Or should I go here long the YM before the high? So this is, I mean, as a manual trader, I would not have enough information, or I would not have a lot of information analyzed to give me the correct answer for this question. And I was struggling. And one of the ways I fixed this is with this trade, right? With computer generated information. With data that we're going to analyze now, I was able, right, to buy the high here after it printed all-time highs on the S&P 500, right? And the computer told me that buying this high had better risk-reward ratio, that this is the NQ, right? That buying at this time here, right? The times on the arrow is the same. So this time here is the same time here, right? This is what a chart trader, a pattern trader or chart trader would see. And the computer decided to go to trade the ES versus the NQ here, right? Or to buy this high, this candle before the congestion. This is what a pattern trader would see, right? Entering at the high here, or entering already at the high of the day, or here entering at the high of the day. However, in the timing, it shows you would have to buy this candle close, you would have to buy this candle close, or you would buy this candle close. The computer analyzed that buying this candle close had less risk and more reward than buying the NQ here or the NY or the YM here, the Dow Jones. And let me show you how I did that and why I did that, okay? So what happened, it was cash coming into all the indexes, right? Most of the day, all the indices were positive. However, this did not translate into same returns for the Nasdaq, S&P, or YM. And what I found myself is that analyzing futures related data, right? So buy and sells on the index itself, on the future index, did not work for me. I mean, I could not find a way that would give me an edge finding, like analyzing buy and sells or price delta data on the index itself. What I did is I went to the underlines, right? And this is how you would see it. Here is the underline, right? For example, it would show the dots. So these are neutral prints. Here we would show the dash, which is negative print, plus the plus, and the plus, which is a positive, and then the dots is neutral. You could see this like from before, right? And the Excel, let me show you, the Excel would show something like this. You see, where it would trade and move, right? So the way the underlines were trading were like this. Oops, sorry. Let me show you here because it's important to show you the exact point. Let me move this here. And I'll go back here. So the underlines were showing this, right? And then the S&P 500 were showing plus, plus, dot, dot, plus, plus. American Airlines was dot, plus, 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 dot, plus, and so on, you know, and because of this data, because of the tick data in the S&P 500 being stronger than the one on Nasdaq and the one on the YM, I had enough information to trade long here, the S&P 500 versus the Nasdaq and versus the Dow Jones. In this case, all of the trade would have worked, but many times we end up buying the high and stop the follow through, or retracing one index less than the other one. So this little system, right, helped me to find the stronger of the indexes and go with the one that worked. So the trade itself, it went long here, right, at that candle that I show you. And then it added here, and then it was liquidating the contracts around here, right, around this time here. And then in the end, I think it closed at the high of near all-time highs, but the trade for the system was already over. So let me show you something that I think it could be beneficial for you to do in Excel and find how you can improve your data, your trading based on computer information. So let me show you the Excel, and we're going to review a couple indicators that I like. One is the ease of movements, then is the index constituents, and correlation and regression analysis on the indexes. And this is data that is used for our option, but I am deploying now this data on a very short time frames to read what the underlines are doing versus what the index itself is doing. So if we go to the Excel, this is a simple Excel where it explains the ease of movement, and I download here the ease of movement, and it gives me, I have this for about 700 components. So it tells me which stocks is a filter to which stocks I expect to move. I expect to day trade. If they are not in the list, simply I remove them. Here is a simple ease of movement with a simple averaging, right? Then I change it into with Wilder smoothing, and instead of using the average, I use an exponential moving averages. And for example, here, I will show you how it works. So here we have Amazon. So if we change this to IBM, oops, oh, here it is. So if we change this to IBM, it will show, right, the current ease of movement of IBM. And if we do the same thing for, let's say, Amazon, it will show for Amazon. We could pick here periods, 14 periods. This is currently this Excel is on day time frames, but we could do this in 5 minutes, in 10 minutes, and so on. And this will filter which stocks are ready to buy for the system and which are not. And if there are many stocks ready to be purchased based on this, sometimes I find it beneficial to trade just the index, right? Because probably it is getting out of a congestion, just like we saw yesterday. And here is the same indicator, but with a weighted simple moving average, right? So these are filters that I use when to trade the indexes or when not to trade the indexes. Then we have the stock matrix, but let me show you. I want to show you the index constituent, right? So let me make it a little bigger. And here we have, okay, this is again the long-term system, right? 1 year, 9 months, 6 months to 1 week, and then there are in the days there are another time frames. But it should be like for day trading, it should be like this: 1 second, 3 seconds, like, and so on, right? So here, these are the Dow Jones, and when they give me ticks to the high stronger than Nasdaq, I expect a larger movement on these stocks versus the one in the Nasdaq. So I would follow trade signals coming from YM versus the Nasdaq. I could do this the same for the SPX. So this would give me the data for 500 stocks. So here we have, you can see 512 stocks, right? So it would give me buy and sell signals filtered by the ease of movement by this indicator, which stocks are strong in the day and which are not, and with a very specific time frame that I feel comfortable trading, right? And to conclude the Excel, because I don't want to take so much time, but I want to show you the correlation indexes. I also take a close look at correlations, like you saw in the example, like for example, the VIX doing a high on the day and the dollar doing a high, as well as the indexes doing a high, or gold doing a high. The way I see this is through correlations and with high signals. So for example, here on this simple Excel, we can see the correlation between I don't know, AAPL, right? AAPL and MSFT and Microsoft. I'm sorry, Microsoft. Right? This is again in a daily frequency, but we could do this for 5 minutes or 10 minutes and so on, right? As filters to trade the index or to trade that specific equity. And we can see the correlation here that is back to from 2016, right? Or we could do the correlation between the VIX, right, and the instruments we trade, the XPX, or so on. So we could see here the correlation. And right now in the days, we don't see like a lot of difference, but sometimes there are like very simple signals. If we do this in 5 minutes or like in 10 minutes intervals, we can see discrepancies on the signals that could show or highlight a movement that the market is not reading yet. And yes, you can look at this with charts, but for me, it's a lot easier to do this with Excel because I cannot have 1,000 charts on the screen and look at the same time at all the charts. But with Excel, you could have pop-ups or filters that it's easier to read. And the last one I want to show you, correlation log, and is this one on the slope of products, right? And here on the charts, it's graphing the last 14 days or the last 13 days, right? These are the closing prices of Microsoft, and the line is the slope. The slope for me is key, right, to trade any instrument. If there is not a certain slope, I will not trade that equity itself. I don't pay so much attention on the slope on indexes, but I do a lot in equity. So for example, if we change this, the slope right now is 0.34, right? Is 34. If we change the one from Microsoft to GE, right, we can see how the slope is negative. Of course, the price charts, I mean, we all know what GE is going through. So this is a great filter working that it does not consider moving average. Of course, it considers price, but it does not consider other indicators, just the slope. And we could do this instead of just graphing or taking into consideration the last 14 days. We could do it for for the last 14 periods. Instead of getting daily data, we get 5 minutes data and so on. So it gets very interesting to trade, at least not interesting, it gets profitable to filter signals based on the slope of the equities. You can see now that GM, right, had a positive day. Let me chart it here so we could see it. Let me do it here. So I will show what GM did, right? So we want the candlesticks of GE, right? So this is what GE has been going through, and now today was a strong candle, and this is probably, or at least one of the trend following systems would not catch this, but a mean reversion system would catch this. But it's important that you would see on this regression line, right? Instead of going into 14 periods, if you put it in 5 minutes or periods or 30 minutes periods, you would see the slope today being strong. And with that such a strong slope, because the charts show, I know because of experience, right? Because of this slope, there is a time for a mean reversion signal here for some of the systems that I follow and I manage, right? So going back to the presentation, I think this is I wanted to recap three indicators that they were not of a lot of use for me on the charts. Is ease of movement, indexed constituents, right? I cannot see hundreds of stocks at the same time on charts, and correlation and regression, which are very important for me in Excel, but they are not important for me at all in the chart, you know. So now we reach the last part of the presentation, where we open for the conclusions and Q&A, and just a little comments I want to say before we open to Q&A. Like what I always like to think that most traders remain humble. I have met many traders through the last 10, 15 years, but the ones that I admire, most of them, not to say all, are very humble traders. I mean, they understand that one mistake can ruin their reputation, so they remain very, very humble. Also, many traders fell at the initial years of pain and they quit. However, those years of pain create the necessary stress to believe in yourself. And trust me, it's very hard to win big if you don't have confidence in yourself and in your system. It's very bad, like I said in the beginning, to question systems and don't follow them like they were meant to be. It's always easier, or it's always better to lower the risk allowed by a system and not do the opposite of what a system is doing, that to close positions because you think the market is already too high or you think the market is about to drop. And mistakes are always part of trading. It's important to look at this as solving mistakes and meditating on those, because it's very important to do that extra work, because it's the only way, for me at least, that had helped me to avoid future losers, you know. And the other thing is, if you want to get what you deserve, you know, connect with people that already have what you want to achieve. You know, look for those results and connect with people that are already there where you want to be in the next 5-10 years, because they could help you. They could give you a path to follow that could improve your trading. Also, before, if I wanna give you I wanna bribe you. So I wanna give you a link to see me trading live, right? In a couple of weeks or so. If you would like to follow me on Twitter or to follow on YouTube, I would not mind like giving you access to my live trading while I do. And if you have questions that are hard to answer or that they will take time, you could contact me through this email, RandBots it's ola@randbots.com, or email me through, or send me a message at Twitter, so on. I will be happy to answer. Okay, Terry, with this, if you want, we open for questions and answer.
Okay. If you have any questions, please feel free to start typing them in. The first question I have is, what is R option in example 3?
Okay, great. Our option is it's a system that I manage, right? It's probably my bread and butter system. Is a market timer on the S&P 500 and Nasdaq, and the way I deploy those buy and sell signals is with options. So there is more information on RandBots, but or email me or contact me if you want more information. But this, my bread and butter system, is the responsible of me being a successful trader.
Okay. How do you pick the underlying stocks?
Okay. Through the filterings, they help a lot. So this regression line helps a lot. So if the slope is not positive, so what I do is, you can see here on the chart where I could put, like, for example, this is the S&P 500, where is 512 products, right? And if we go to the Nasdaq and DX, right? So we retrieve the Nasdaq, right? And in the NDX is 111 products, including the index itself. So I do the slope for any of these instruments with this regression line in 5 minutes, 10 minutes, 15 minutes. And if I like the ease of movement with this simple moving average, right, it's a candidate to enter long or short. And if there are many stocks that match the criteria, I just go in the index and I purchase the index itself, because it's more liquid and it's easier to just buy the future and get the trade done easier than buying 3 or 4 underlines. But this is one is filter that works for me, and it's something that our option uses in the longer time frames.
Okay. How do you define ease of movement?
Okay, I think that Wikipedia could do that better than myself. So you could copy and paste it on Wikipedia, or like, I'm sure there is like on many trading terminals, or like your platform, or Investopedia, any of those could define it better than me. So I don't want to get into the details.
Okay.
And if you are interested, it's better that you do the research. That way you find confident or not on the system. Yes.
Okay. Let's see. Are there any other questions at the moment? If you have a question, please type it in. If not, I will give another minute or so, and then we will call it. Okay, I think that is it for the webinar, for all the questions. Thank you for the presentation today, for the information you gave us, and for spending some time with us.
Oh, you're welcome. Thank you so much, Terry, and thank you so much for attending the webinar.
Absolutely, thank you.